I am the Chief Investment Officer of Beringea. We are an early stage investor of £1 to £20 million in high growth businesses, and I'll give a little bit more information about us. We have offices in the US and UK, about a 30-year investing history. We have $675 million that's in the active funds. About $200 million of that is dry powder, so we are very actively investing. Our US office is primarily traditional GP/LP funds, kind of 10-year funds. The UK is primarily comprised of VCTs, which are evergreen funds, so we'll keep recycling the cash. And we also have an IHT fund in the UK. Our equity checks are 1 to 20 million. First round for UK investment, our sweet spot is about 3 to 5 million. I'm going to talk about kind of three aspects of early stage investing. One of them being just the UK market and how that's developed over the course of the last 10 years, because that's been my history in the market. How the game has changed for us specifically, things that we're doing differently within the last 10 years, but also within the last 5 years. And then because of our US and UK angle, I'm certainly going to talk about how we perform relative to the UK and where the key differences and changes are.
People, are you ready? Are you ready for the ultimate tech startup competition? Let me hear it. Disrupt!
Hello, my name is Saeed Jabrani. I'm the CEO of Ametabug, and we're here to revolutionize the way you report bugs on your mobile platform.
Happen will revolutionize location-based mobile news aggregation as you know it.
We're making the world a better place through Paxos algorithms for consensus protocols.
And we're making the world a better place through software-defined data centers for cloud computing.
A better place through canonical data models to communicate between endpoints.
A better place through scalable, fault-tolerant distributed databases with ACID transactions.
And we are truly local mobile social.
And we're completely so-mo-low.
And we're molo-so.
We're low-mo-so, bro.
We were so-low-mo, but now we're mo-low-so. No, mo-so-low. No.
Next up, Executive Chairman and Chief Visionary Erlich Bachman, presenting Pied Piper.
You probably get the point. I played that mostly because I absolutely love the program, but also because I think it's an interesting look at where we are versus 7 years ago, 10 years ago in 2007 when I first started doing this. In part, the idea of a television program, especially an HBO smash hit focused on a comedic version of the venture capital community, just seemed ridiculous. And there wasn't this celebripreneur culture. But I think over the course of 10 years, the view of startups and venture capital and early stage investing has become much more mainstream in pop culture. And that's great because the importance spreads beyond just entertainment. And if we kind of, I'll do a brief run through of the last 10 years, but I joined Beringea in 2007. And the only reason I got a job was because they couldn't find anybody else. And I only mean that a little bit tongue in cheek. If you think back to 2007, every banker was very well employed. And they were making more money than they ever thought they would, and that was never going to end, obviously. And so for the venture industry, which had traditionally hired out of primarily 3i, BlackRock, Apex, KKR, all of the investment banks, they had to look to other places to hire. And at the time, I was a consultant for BCG, and myself and I think about 6 of my peers all kind of jumped ship to go to different VCs at the same time. And it was the first time that the VC community started looking really outside of, I would say, for the kind of mid to senior level hires outside of traditional banking. And if we think back to 2007, for those of you who might remember, in 2007, a lot of the term sheets, a lot of the processes, a lot of the valuations looked very similar. When I joined Beringea, there were 176 active VCT funds. I think there are about a dozen that continue to actively perform now, and part of that is just a natural cycle of the great performers rising up in consolidation. But it also is representative of how dramatically the industry has changed from 2007 to 2017. And so if we kind of run through some of this, and I think Nazar did a great job of pointing out probably in a more detailed fashion what's happened since then. But we rode the wave of 2007 being great, and in 2000, I think, I've helpfully cut that part off because otherwise it would wreck my graph. But in 2000, I was in New York consulting for businesses like Boo.com and eToys.com, if you remember those businesses. And I participated in an MBO I didn't really understand. And in my early 20s, I got theoretically rich and then tangibly poor very quickly. So that was quite a good life lesson for me. But starting with 2007, we kind of rode the wave into 2008-9 where we had the crash. And then in 2010, 11, 12, what we saw were a whole lot of really smart, unemployed people starting their own businesses. And we saw a good wave of investment actually coming in, starting in 2010, 11, 12, as those businesses became more and more tangibly investable. If we kind of start fast forwarding to, I guess, everything mobile, and then the dawn of cloud computing enabled by Amazon Web Services, to kind of the time frame of all of the unicorns. And if we think back to kind of 2007, there were actually, I mean, Sherry Cortu's business, Interactive Investor, they reached $1 billion, I think, around then. At the time, we just called billion-dollar businesses good businesses, not unicorns. But we've kind of got the dawn of the unicorns in recent years, and of course the fall of the unicorns as well in recent years. One of the major differences from 2007 to today is the amount of money and the type of money available. And this is not comprehensive. This is a smattering of the funds that have been raised between 2007 and 2017 that in total exceeded 12 billion, and that doesn't include things like the lending book for Funding Circle. We've also seen the emergence of more specific types of funds, so people like, there's somewhere here, but like Felix Capital and Albright that have particular sector angles that they're investing in. So we can certainly see that the ecosystem is evolving quite significantly and the investment is coming. I also want to talk about the supportive network. And in 2007, we had an interesting network of people who were highly supportive of early stage companies. And in 2017, that looks very different. We have a great ecosystem. And I was actually at I think it was London and Partners Silicon Valley Comes to the UK mentorship event not that long ago. And there was a CEO who was appropriately talking about, I have these problems in HR, I have these problems in recruiting, what do I do about it? And immediately the table started talking about all of the support programs available for dealing with things like that. And the CEO actually got understandably frustrated and said, look, there's about 8,000 programs I could go to for coaching and mentorship, and how do I do this? I just need to get the one right one. So I don't want to say it's overkill, because I think this is great, and we need to spend time figuring out which are the right ones for the right people. But the ecosystem has significantly evolved. I just wanted to talk a little bit about more general market trends that we've observed, and I'm going to then apply some of these to specifically Beringea. And this focuses really more on the last kind of 2 to 3 years. We are seeing a higher risk appetite from investors, which is potentially leading to more growth plans, although this could be cyclical, and I'll come back to that in a little bit. But if there is a higher risk appetite and people are willing to take bigger bets, write bigger checks, and do riskier things, then we're going to see more ambitious plans coming through. The higher initial check sizes at earlier stages, I think Nazu showed us a little bit about the evolution of kind of the deal size and check size. Certainly at our end of the market, we are absolutely seeing bigger check sizes, and I'll come back to personalize this in a little bit. But we've certainly seen it's not unusual for pre-revenue businesses to have already raised somewhere between $1 million and 10 or even north of that at early stages. And then along with the bigger check sizes and the higher valuations, higher amounts of money, we're seeing businesses kind of buy their way into meaningful revenue faster. That's not meant to be derogatory. It's something that we've seen in the US in perpetuity. And I think this is actually probably more of a correction, whereby we used to really drip feed companies. Here's your first 200K, then your next 500K. Go make a few million off of that, and then you get the next million. And now we're saying, here's 5, go get yourself to 5 or 10 million. I think one of the themes, and this is probably arguable, but I think especially in 2016, we were waiting for a market correction that didn't really happen. And there was a whole lot of buzz when the Bessemer Cloud Index actually fell, I think in Q2 or Q3 2016 of, oh, here it comes, only to see that the next quarter it was actually higher than the previous quarter. So I think that kind of market correction in terms of valuation and market multiples never really happened, and the market continues to be quite bullish, despite things like Brexit and Trump. And then the last bit, and I don't have a good explanation for this one, but I think it's true across the industry, but certainly the people we've been talking to in the last couple of months, deal flow is phenomenal, but the pace of deals and the pace of new deals is not specifically fast. And there could be a variety of reasons for it. I'll talk about kind of where I think it is for us to some extent in a minute. So making this a little bit more personal, thinking about deal flow in sectors, and just this is more of a 5-year view than a 7-year view, and we don't generally publish these numbers, but we're all friends. So in 2011, the things that made it into our deal flow, i.e. they were potentially investable for us, we had about 227 deals. And in 2011, we were good investors with great returns growing every year. In 2016, we were good investors with great returns growing every year. But you can see that the amount of deal flow, this means deals that actually qualify as we could invest in this, were about 4 times where they were in 2011. And almost more interesting, about a third, or a bit more than a third, was comprised of things that weren't even terms that we were really using in 2011. And I think it's been said a couple of times, tech is no longer a sector, and that's probably true. And to be fair, the colored bars over here, we went back and recategorized from education to edtech, for example. Valuations, I'm just going to say a couple words on this one. If I look back to 2007 versus 2017, the average price we paid, looked at as a multiple of revenue, is actually 4 times higher in 2016 and 17 than it was in 2007. You could say that's either because we were cheap bastards in 2007 or we're much more bullish today. But I think some of it is actually born of this idea that if we believe in more aggressive growth plans, more aggressive opportunities, and more aggressive outcomes, you can pay a much higher price on the entry because you're going to make your return on the exit. If you don't really believe in the massive high growth plans and you don't really think that there's such an opportunity, then of course your prices are going to be lower. So I think extraordinarily high valuations right now are born in part out of exuberance in a bull market, but in part because we can really see tangible outcomes. And I think Nazza mentioned a number of the Klarnas and iZettles and certainly Skypes and Spotifys of the world that are helping us get more confidence. Check sizes are definitely up. I think I talked about that a little bit earlier, but check sizes and syndication for us are significantly different. So our average check size just from 5 years ago is 175% higher than 5 years ago. But I think more interestingly, the round sizes are 600% bigger on average. This means that the companies are taking on much more funding at much earlier stages. So our participation is going up, but 75% of the deals that we did last year were syndicated deals, and I think that will continue. And I think one of the other trends that we've seen is dry powder from corporates. There are a lot more corporate VCs that have very big checkbooks, but they are very picky. They're not just throwing money around. But there are a lot more corporate, active corporates. The deal process, I'll do this one quickly, but if you think about back to 2007, when most of the people coming into VC were ex-bankers, a lot of the processes looked more like banking processes. And I'll just show you briefly. This was phase 1 of our deal process in 2008, phase 1 of 3. This is our entire process today. And I think that's true across the industry, in that the industry itself has become much more streamlined and much more appropriate to the types of deals that we're doing. The last bit I'll talk about is how we sell ourselves to entrepreneurs, because this has become increasingly important. The UK market is becoming increasingly competitive, and you have to be increasingly differentiated in order to win deals and hold your position. So a number of the things that we're doing, since I joined, every senior manager we've hired has had their own startup experience, and I think that carries a lot of weight with entrepreneurs, a lot more credibility. The US office allows us to offer on-the-ground US assistance, which means you can set up an office and a desk there. We can introduce you to potential customers, suppliers, clients, politicians who might be helpful. We can also help you understand and navigate things like the tax system, the legal system, help introduce you to some of the first potential employees or partners you might use in the US. We have a dedicated online portfolio resource. One of the things that we add there is a recruitment network. So if you post a job to Berengea's website, that's not very helpful because not many people come to Beringea to look for portfolio jobs, but we then blast it out to all of our alumni networks, which includes things like McKinsey, BCG, HBS, INSEAD, Harvard. So all of our alumni networks also get the job postings, and we have had a number of companies recruit successfully that way. We do a portfolio conference that we call the Invested Conference every year, where all of the CEOs and senior managers come together for a half day to a day of seminars, discussion, and mostly interacting with each other. That's really the objective. Sector-specific meetups. This is often to talk about and exchange notes on things like common clients, common suppliers, common technologies. And then the last one is a recently introduced concept of commercial pitch days, where we will invite the CEOs of large corporates who are potentially clients of the portfolio companies in sector-specific ways to come to come to our offices for a pitch day, which is 7-minute pitches, really quick ones from each of the relevant portfolio companies. So it's a chance for the portfolio companies to have a direct interaction with senior managers at potential clients. I was now going to talk a little bit about US versus UK, and this is a little bit more targeted at investors than entrepreneurs. But if you are an entrepreneur looking to go to the US, we do publish a US playbook on kind of first steps, how to think about going. Do feel free to email me and I'll make sure we get you a copy. But I think we touched on this earlier. Valuations do remain higher in the US. I'd love to be able to say we're kind of at pricing parity, but they are higher. However, this is primarily driven by the large IPOs. We are invested in, the UK office of Beringea is invested in, I think now, 8 US companies, and we're co-invested with people like Khosla and Intel Ventures and NBC Universal, and we don't pay different prices, nor do we sit there arguing about whether the price should be higher or lower. So I think when you think about on a day-to-day basis, with the exception of kind of the FANG businesses, the valuations start to become much more at parity, but there is a difference in valuations. The next one I think is a really important one for us to think about. There's a systemic difference between what the US can invest in and what the UK can invest in based on the size of the funds. A big fund in the US is a $5 billion fund. A big fund in the UK is a $500 million fund. By definition, we can only fund 10% of what the US could fund in that situation. We're trying to do better, primarily through syndication, but until we have these kinds of mega funds, we're never going to be writing the checks that the US can write. And some of this might change with things like the new SoftBank fund. I'm very interested to see what they're going to be doing, but this is a systemic issue that is going to take a while to correct. A more subtle difference, the Valley is based on kind of 60 years of a culture of entrepreneurship that's just going to take us a while to catch up on. And it has its roots in things like the incubator culture of Stanford and also the entrepreneurs investing in entrepreneurs. A lot of the mega funds in the US were started and set up by ex-entrepreneurs and seeded with their own money. We're seeing more of that happening. I mean, Atomico is a great example of it. Brent Hoberman with Founders Factory, and then Natalie and Arnaud Massenet, following the sale of Net-a-Porter, have both set up some of their own funds. So I think we are seeing that start to happen. And the more we have mega exits, that leads to more opportunity for us to have some of the mega funds. Another thing to keep in mind is just there's the US and then there's the Valley, and those are different ecosystems. And I've heard it said on quite a few occasions that the Valley pays for vision, New York pays for revenue, and London pays for profit. And while that's a massive stereotype, it's probably born out of some truth. And so if you think about the valuations and the money that goes into the market outside of the Valley, a lot of the parity starts to disappear. So a lot of the differences start to disappear. One of the things that we've noticed specifically in the last year is the benefit of investing in profitable businesses. So we as a company are not specifically unicorn hunters. We do really well out of businesses that sell for somewhere between $50 and $500 million. We would rather give a company the right amount of money than a lot more money and have them kind of be forced to spend it relatively quickly. We're absolutely seeing that in bullish markets, there's much more energy and inertia going towards vision. In markets where there's any kind of uncertainty, be it political or economic uncertainty, we're seeing more of a rush to profit. And I was at the Founders Forum conference. Obviously, I'm sure everybody was busy with London Tech Week events last week, and saw one of the, I won't name a name, but one of the very big US VC investors who we've talked to over the years but never really done anything with, had a great conversation. They asked, should we be looking at anything in the portfolio? And I kind of said, well, I'm not sure you'd be that interested because we invest for profit. And they immediately said, when can we come see you? And I think that holds true. It's one anecdote, but I think it holds true that US investors get more excited about profitable businesses when they're a little bit uncertain. And then we're absolutely seeing increasing levels of cross-border co-investment. A lot of this is driven by the corporates with dry powders. The corporate venturing arms seem to be almost more interested in cross-border deals than some of the VCs. So it's just going to kind of wrap up. And where do we go next? So I think within the UK, we do have this massively supportive ecosystem, and people recognize the value of early stage and venture investing. I think the next phase of what we need to start putting effort into is more of the scale-ups. So once you've gotten past the first incubator level and past the kind of initial mentorship, what resources are available to help continue scaling up? And I think Alice is actually going to be talking about that shortly. For us, I expect that we're going to continue to increase the check sizes that we're writing, especially across multiple rounds. We do have to maintain our own discipline around growth cap because there's always pressure for us to start looking at doing riskier and riskier things with bigger and bigger check sizes. And then the last bit is just relative to the US. I think one of the big hurdles is that systemic difference in fund sizes. And I think until we get there, it's going to be difficult to say we're at parity with the US. But I might also just question, do we need to be? Is it really important for us to have a similar level of unicorns, or is that unicorns for unicorn's sake? So I do think fixing kind of the systemic issues and being able to write 100 million checks will put us in a good place. That's it. Thank you.